Hello, it's Connie from Prosperity Finance. My goal is to give you timely insights and tips to help you master the game of finance and ultimately help you achieve your goals. Now, since the government introduced the interest deductibility rule early this year, we noticed that there are some area of home loans that people need to be aware of. If you don't do them correctly, then you end up paying more tax, or your accountant will have a headache when they prepare your financial at the end of the financial year. So today I'm going to give you 3 tips. If you have investment property, you can't really miss this video because that help you to be tax efficient and organized. Okay, so let's start exploring what are the 3 tips. So number 1 is offset loan accounts versus revolving. Now, I'm not going to explain what is the offset and revolving because we have a video for each and the parts. So if you're not sure what they are, then you can go to this video and have a watch and see what these are. If I summarize them, basically they achieve a very similar goal, which is to use your savings to offset your loan interest in order to achieve saving interest purpose. Now, with a revolving, almost every bank has that kind of products. With ANZ, they call Flexi, ASB called Orbit, BNZ call repay, and Westpac has a choice every day. Whereas offset, some banks have them, some not. The best offset products are BNZ and Westpac. So they call total money and trace offset. Now, trace offset, generally speaking, is more powerful than the revolving because you can not only offset your own money, you can also offset your parents' or kids' money if they're happy to forget about the interest income. So it's more powerful. And some banks like Westpac, they don't even charge the monthly fee for offset, whereas revolving normally have a monthly fee between $10 to $12.50, $12.50 a month. So offset has a lot of merits. However, since the government has this interest deductibility rule, you have to be careful when you decide to use offset accounts. I'll give you an example. Now, I had a client recently. She has $200K home loan. The loan original purpose is for their home. They also have a $200K cash available from parents gifting. So they asked me what to do with the money. Should they pay off the loan or how they do it? Also, they have a plan to purchase a property that has development potential. They want to develop the property and then keep them as future rentals. So I analyzed the situation. Basically, they have 3 options. One is paying off the loan completely. If they do that, that's totally fine. They minimize the interest costs purpose. But when they need to use the money, especially in the early stage of developments, they need money to pay council fees, to pay design fees, etc., consent fee. They have to go through the full application to apply top-ups. So it's not very convenient if they pay off completely. Now, 2 other options is, one, if they convert it into offset, the other is converted into revolving. Now, both would give achieve the purpose of minimize the interest costs when the money is not used yet. However, in terms of interest deductibility, is completely different. If they go with the offset option, that means basically they move their money from the offset accounts. They have offset saving accounts. They move the money to using the money for early stage development cost. Now, when they move that, that part of money there's no interest because this is their money, right? Now, on the other hand, the loan for their home is start incurring interest again because there's no cash to offset. So that's not ideal, right? But if they converted their current loan into a revolving, then it's a different situation. Because when they do a revolving, they basically pay off their loan. but they also have the ability to withdraw the funds when they need it. They don't need to go through a bank for full approval. They just become available funds. So when they need to use the money, yes, they start incur interest, but all the loans that they use is for the new build. So all the interest will become interest deductible. So that help them to minimize the profit against their future rentals. So revolving in this case is better than using offset and better than paying off the loan completely. So this is quite different in today's world since the government introduced that interest deductibility rule. So you need to really be careful about. Now, number 2 tips is do not combine your loan, especially the loans for newly purchased property that you purchase from 27th of March this year. Because this part of a loan, if it's existing building, not new build, then you cannot deduct interest against the rent from October this year. If you combine this loan, maybe because it's small or whatever the reason you want to combine with existing loan, then it's going to create a lot of headaches for your accountants. With the rental property you purchase before the 27th of March, it's kind of less important. But now it is important that you keep the accounts for its own purpose. It's easy for trace later on if required. So this is the number 2 tips. Now the last tips is about if you are in a situation where you have a lump sum money and you're not going to use the money to purchase new property, etc. You just want to pay down the loan. Then how are you going to, which accounts you should pay down? So my principles are, if you have a home, you still have loan for your home, then pay down the loan for your home first, because you want to discharge your home sooner than later. So that's first priority. Number 2 priority is that if you have purchased a property, rental property, from 27th March this year, and it's not a new build, it's just existing dwelling, and you use it for rental property, then you pay down this loan first, because from 1st October, you can't deduct the interest against the rental. So if it's not deductible, then it makes sense to pay down this loan fast. And then if you still got money, you can pay down the loan for your rental property, which were purchased prior to 27th March. So this order is for asset protection, but also to help you be tax efficient. So these are my 3 tips to help you be tax efficient and also help your accountant to complete their job easily. I hope this video is useful, and if you like our video, please do subscribe our channel, because every week we have great insights to share with you. Thank you so much. I will see you next week. Bye bye.